Many people feel that car insurance is a legalized scam and they're a bunch of rip-off artists. In this video, we're just going to look at that assertion, whether it's true or not. We're going to look at some of the traps that insurers put in place to make sure they don't have to pay out when there's a claim. And if you know what those traps are, you can avoid them or sidestep them. And very often it's just a matter of being aware when we fill in a form, the implications of what we are actually putting. The basic tenet or principle of car insurance or insurance in general is to put you back in the position you were in before the loss occurred. But the reality is often somewhat different from that. People often feel that they're in a worse situation after their insurance has paid out. And we're not just talking about the excesses or deductibles that are taken from the policy before a payment is made. We're talking about the overall claim settlement. I know a lot of this stuff because I worked as an insurance broker for about 14 years. It was one of the first jobs I had when I left full-time education. And I really got to see how the system worked. And we were dealing with people's claims. We were the middleman between the person and the insurance company. And I think in this video, I've managed to cover most of the areas that people get caught out on. Watching this video will give you a really good overview so you can avoid these traps that insurers are actually using to reduce or avoid paying out a claim. First up, let's look at the traps insurers put in their policies. And really, I would recommend you go to a good quality, big name insurer. A lot of the cheaper deals from lesser known brands often have more traps, more restrictions, and are more inclined to refuse a payout. And we've got to remember that the claims adjuster is not on our side. The claims adjuster or the loss adjuster is there to reduce the amount the insurance company are paying out or look for ways of avoiding it completely. The policy wording really is a very boring, long legal document, and I would encourage you to actually read it. You'll probably be surprised at some of the things that are excluded and some of the things that are not necessarily covered when you think they might be under your standard motor insurance. Checking your insurance policy details at renewal is a good policy to have because things change. Maybe the annual mileage we do has altered over the last 12 months. Maybe we've got a new job, and it really is important to just make sure that the insurer is aware of these at the renewal date. They'll ask us to check the details carefully, and they're really looking for us to notify them of any significant changes to the risk that they are taking on, and failure to do so can lead to refusal to pay a claim at some point over the next 12-month period. Now, some things that happen during the year, we should really notify the insurer as it happens, but there's often a little bit more leeway at mid-term when things change, but it depends on the item. If we change our car or there's a significant change to the car itself, that becomes instantly notifiable. If our job description has slightly changed, some insurers are happy to wait until renewal date as long as we're not in a high-risk occupational bracket. We also, at renewal or when we take a policy out, need to declare any accidents or losses, whether covered by insurance or not. Often when you sign up for a policy, the wording is rather vague on the application form, and then when you fill in a claim form, it gets very, very specific. The insurance company need to know if you have been involved in any kind of loss, and technically a bird flying into the window and breaking it is a loss. You may not even have claimed on your car insurance, but that is a loss that they need to know about. And if we've not disclosed all of these losses or all of these incidents, assuming that because an insurance company didn't deal with them, we don't need to notify the insurance company, that really is a great trap for them to use at claim time. As soon as we see the claim form and it's asking very specific questions about losses not covered by insurance, whether we claimed or not, we might answer that in a different way to how we answered when we took the policy out. The only way around this really is to just be ultra careful when we're filling in that proposal for car insurance at the outset. Another trap often used on the application form, the insurance company will say, is your car standard? On a claim form, it'll ask if your car has been modified, adapted or altered in any way from the standard specification. And for some insurers, that can include fitting roof boxes, fitting roof bars, fitting tow bars, even fitting a reversing camera or a dash cam. If these items are permanently wired into the car's system, they could technically be construed as a modification. And if the insurance company find out about that after we've made a claim and we've not notified them at the time this item was installed or when we took the policy out, we could find ourselves in a situation where our claim is denied. Now, many insurers are a little more flexible. Some of the items that I've listed there, it's unreasonable to expect an insurer to exclude these specifically as adaptations or modifications. They're merely accessories that people are adding, but some insurers have been known to argue over them, require increased premium, or use them as an excuse for not paying out a claim. When insurance companies make an offer for your car, it's rarely a fair offer. They're usually getting away with the bare minimum offer. Now, what we can do is negotiate over that offer. Now, they might even say that if they renegotiate with us, we could end up with a lower offer, but don't let that put us off. If we have a quality case of argument against the valuation that they've provided and we can back that up, we stand a really good chance of getting an increased offer. Now, the first thing to bear in mind is that there are regional variations. We live down here in the south, so London and the southeast, car prices do tend to be much higher than they are in other more deprived areas of the country, should we say. When the insurance company make an offer, it's based on the average book prices for the whole country. If we can argue that this model of car that we've got in that condition costs more money locally, we could use that as a basis, and we would go through for sale ads and snip out all of the similar cars that we've got and use that as justification of a higher offer, because we want to replace the car that we lost. Now, another clause that is often used in insurance, and particularly house insurance, but sometimes on car insurance or classic car insurance where there is an agreed value, is underinsurance. Underinsurance is where we underdeclare the value of the item we're insuring. If, for example, it was worth 50,000 and we said it was only worth 25,000, we've only insured it for 50% of its real value. Now, when insurance companies come to pay out a claim, they can legitimately say to us, well, you've only insured 50% of the total value of this item and it's been lost, so we're going to pay you 50% of the claim settlement. But like I say, that is unusual to happen on a car insurance, but often insurance companies will use this when they're paying out a claim for other types of insurance or those agreed value policies. Betterment is another excuse that insurers use to reduce the value. Now, for example, we've got a set of tyres on our car and they've used up most of their tread life. For argument's sake then, let's assume that they had 8mm of tread new. They've only got 2mm of tread left. So we've used up a big proportion of their useful life. They're actually just above the legal minimum. If the insurance company replace that set of tyres, they can argue that they're putting us in a better position than we were at the start because the tyres are now new. They've now got 8mm of tread instead of 2mm, and they could legitimately reduce the value of that item or the payment and ask us to make a contribution toward that aspect of the repair because they're improving it. They're providing us with more tyre life. Other clauses are the use of the car. Here in the UK, we basically have a few different levels of use of our car. We have social, domestic and pleasure. That is just for, as it says, using the car domestically, taking the kids to school, going to the shops, visiting friends. The next level up includes commuting. And to be honest, most policies sold in the UK are social, domestic and pleasure, including commuting. Now, commuting is often only to one permanent place of work. If we work at multiple locations during the day or there are multiple offices we're traveling around, commuting is often not sufficient to cover that. We would then need Class 1 use or business use, which is allowing us to use the car in connection with our occupation or our employer's occupation. And that would include traveling to multiple places of work or multiple destinations for work purposes. That, however, would not include the carriage of passengers for reward. If you're making a profit carrying passengers like you would if you were an Uber driver or a taxi driver, that is not covered under that form of business use. And if we're carrying packages for delivery, again, that is not covered under that Class 1 business use. We would then need to go to Class 2 business use, which includes this element of hire and reward, allowing us to carry passengers or packages for payment. We see a lot of takeaway drivers falling foul of this, thinking they're covered for the job they're doing, and actually they're not. And very often it's a gig economy. They're taking any work that crops up, and they've often just moved into the fast food delivery because there was an opening at their local place. And when they have an accident, the insurance company find out that they were delivering food for this takeaway place, they're going to be hit with no cover, and they're going to have very serious problems to deal with. They're going to be in a very dire situation without car insurance cover, having to pay the claim themselves and repair the damage to their vehicle themselves as well. Policy excesses, or in some regions these are called deductibles. This is where we agree to pay a contribution toward every claim, and the insurance company will give us a discount. If we said we would pay the first £1,000 of any claim, we'll get a larger discount than if we only agreed to pay the first £50 of any claim, because that renders a lot of claims pointless making on the insurance at all. If most of these little incidents can be repaired for less than this excess payment, we're going to do it ourselves, and the insurance company are not going to have all of the paperwork and all of the costs associated with dealing with that claim. But we need to be careful that we understand the policy wording, because often we might have agreed to pay an extra £50 or £100 towards a claim, but if the person driving the car on our policy is young, for example, they're under 25, that may instantly attract an additional £250 excess. There are often different excess amounts depending on the type of claim. If it was a theft, if it was a fire claim, or if it was an accident damage claim, or even a windscreen claim, they all appear in different sections in the policy and often have different amounts that we have to contribute are deducted from the claim settlement that we get from the insurance company. Another principle of car insurance is taking reasonable steps to prevent the loss from happening. And often if a car is stolen and the keys are inside the car, or you've left the car with the engine running and someone's been able to steal it, you can't expect cover. That's specifically excluded in your policy wording. With anything though, you've got to take reasonable precautions to prevent a loss from happening. And if the insurance company decided there was a big aspect of negligence on their part, that could give them a basis for refusing to pay out on your claim. And this leads us also into the situation of mitigating our losses. So if an insurance company feel that our losses have been blown out of all proportion, they'll refuse to pay it. And classic example really is our car's off the road, we're claiming for a hire car for a period of 2 weeks, we've gone for a limousine instead of something comparable in size, so straight away we're in a situation where we're trying to improve what we had originally, which was not what the insurance company's intentions are in terms of their policy and their policy wording. And they could refuse to pay all of that claim or just pay a proportion of what they felt was reasonable. But I've known situations as well where people have claimed hire cars for a couple of weeks. They've only done 50 or 60 miles in those couple of weeks, which is probably normal for them. It would have been much cheaper to go out and get a taxi or use other means of transport for that short mileage. And again, the insurance company can come back to you on this "you haven't mitigated your losses" clause and refuse to pay out for that aspect of the claim. Your best defense then is to know your policy, notify the insurer, keep a record of these notifications through the year. If we've sent an email to them, make sure that email is printed out and we've got a hard copy somewhere. If we do it by post, again, make sure we've got a copy of the letter that we sent to the insurer notifying them of what's been done. And don't get caught out. Understand that when we fill in the application for insurance, the questions are often more detailed when we come to make a claim. Find out what the true implications are of the question. We're not going to do ourselves any favour by underrepresenting the risk to the insurers. If we've changed the alloy wheels, if there's a modification to the car, if we've adapted it, if our class of use is slightly out of the ordinary, if we've got a high risk occupation and we're trying to hide that by lying, saying that we're in a different occupation, as soon as we make a claim, this is all going to come to light and we just find ourselves in that situation without insurance. If an insurance policy is declared void, that can have implications on future policies that we take out because we've technically been refused insurance, and that is a big red flag when it comes to taking out a policy. And we can find ourselves in a situation where only a few high risk insurers are prepared to offer us a quotation just because our insurance has been declared invalid or there's some note of fraud with insurance companies on our record due to a misrepresentation of one of these facts. Thank you for watching this video. Please boot the like button. That really does help us to get out there. If you haven't subscribed to the channel, please do so, because again, that helps the algorithm see that we're a popular channel channel, and I've lined up this video and this playlist that you should find really interesting. Thanks for watching. See you in these next videos.